Hello friends, welcome to eCraft Geeks. Today we will be discussing about Japanese candlestick. Trade summary. The Indian stock market is open from 9:15 a.m. to 3:30 p.m. During the 6 hours 15-minute market session, there are millions of trades that take place. Think about an individual stock. Every minute there is a trade that gets executed on the exchange. As a market participant, do we need to keep track of all different price points at which a trade is executed? The market opened at 9:15 a.m. and closed at 3:30 p.m., during which there were many trades. It will be practically impossible to track all these different price points. In fact, what one needs is a summary of the trading action and not really the details on all the different price points. By tracking the open, high, low, and close, we can summarize the price action. When the markets open for trading, the first price at which a trade executes is called the opening price. The high. This represents the highest price at which the market participants were willing to transact for the given day. The low. This represents the lowest level at which the market participants were willing to transact for the given day. The close price is the most important because it is the final price at which the market closed for a particular period of time. The close serves as an indicator for the intraday strength. If the close is higher than the open, then it is considered a positive day, otherwise negative. The closing price also shows the market sentiment and serves as a reference point for the next day's trading. For these reasons, the closing price is more important than the open, high, or low prices. The open, high, low, close prices are the main data points from the technical analysis perspective. Each of these prices has to be plotted on the chart and analyzed. Overview. Having recognized that the open, high, low, and close serves as the best way to summarize the trading action for the given period, we need a charting technique that displays the information in the most comprehensible way. If not for a good charting technique, charts can get quite complex. Each trading day has 4 data points, that is, open, high, low, and close. If we are looking at a 10-day chart, we need to visualize 40 data points as there are 4 data points per day. So you can imagine how complex it would be to visualize 6 months or a year's data. As you may have guessed, the regular charts that we are generally used to, like the column chart, pie chart, area chart, etc., do not work for technical analysis. The only exception to this is the line chart. The regular charts don't work mainly because they display one data point at a given point in time. However, technical analysis requires 4 data points to be displayed at the same time. Below are some of the chart types: line chart, bar chart, Japanese candlestick. This module's focus will be on the Japanese candlesticks. History of the Japanese candlestick. Before we jump in, it is worth spending time to understand in brief the history of the Japanese candlestick. As the name suggests, the candlesticks originated from Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, a Japanese man named Homa Munehisa discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Candlesticks show that emotion by visually representing the size of price moves with different colors. Traders use the candlestick to make the trading decision based on regularly occurring patterns that help forecast the short-term direction of the price. Though the candlesticks have been in existence for a long time in Japan and are probably the oldest form of price analysis, the Western world traders were clueless about it. It is believed that sometime around 1980s, a trader named Steve Nissen accidentally discovered candlesticks and he introduced the methodology to the rest of the world. He authored the first ever book on candlesticks titled Japanese Candlestick Charting Techniques. which is still a favorite amongst the many traders. Many of the candlestick patterns still retains the Japanese names, thus giving an oriental feel to technical analysis. Candlestick anatomy. In a candlestick, the open and close prices are displayed by a rectangular body. In a candlestick chart, candles can be classified as bullish or bearish candle, usually represented by blue, green, white, and red, black candles respectively. Needless to say, the colors can be customized to any color of your choice. The technical analysis software allows you to do this. Let us look at the bullish candle. The candlestick, like a bar chart, is made of three components. 1. The central real body. The real body rectangular connects the opening and closing price. 2. Upper shadow connects the high point to the close. 3. Lower shadow connects the low point to the open. Have a look at the image below to understand how a bullish candlestick is formed. This is best understood with an example. Let us assume the prices as follows. Open 62, high 70, low 58, close 67. Here we can see the high 70, the open near the 62, the close near the 67, and the lowest point 58. Likewise, the bearish candle also has three components. The central real body, the real body rectangular which connects the opening and closing. However, the opening is at the top end and the closing is at the rectangle's bottom end. Second, upper shadow connects the high point to the open. Third, the lower shadow connects the low point to the close. This is how a bearish candle would look like. This is best understood with an example. Let us assume the prices as follows. Open 456, high 470, low 420, close 435. We can see it has opened near the 456 range and it had made an high of 470. It made a low of 420 and it closed near 435. Once you internalize the way candlesticks are plotted, reading the candlesticks to identify patterns becomes a lot easier. This is how the candlestick chart looks like if you were to plot them in a time series. The green candle indicates bullishness and red indicates bearishness. Also note, a long-bodied candle depicts strong buying or selling activity. A short-bodied candle depicts less trading activity and hence less price movement. To sum up, candlesticks are easier to interpret in comparison to the bar chart. Candlesticks help you quickly visualize the relationship between the open and close and the high and the low price points. Why do candlesticks work? Price action traders rely on candlesticks because they convey a great deal of information of each trading period in a visual format that is easy to interpret, allowing traders to compare the behavior of price in different time periods with a quick glance at a price action chart. Each candlestick can be read as a meaningful part of the developing narrative of price. They communicate the market sentiment, whether and what extent bears or bulls were in control, and how far traders managed to push price in both directions. For example, a long candle's body with no wicks indicates a definitive shift in the struggle for power, whereas a candle with a long upper wick beyond its body indicates a more continuous period with an effort by bulls to push price higher than that was pushed back by pressure from bears before the close of the candle. Certain recurring candlestick patterns have become more popular among traders as reliable signals for future market behavior. The ability to read candlesticks allows the price action trader to become a meta strategist taking into account the behaviors of other traders and large scale market movers. In other words, candlestick patterns help traders. A note on time frames. A time frame is defined as a time duration during which one chooses to study a particular chart. Some of the popular time frames that technical analysts use are monthly charts, weekly charts, daily or end of the day charts. Intraday charts are 30 minutes, 15 minutes, and 5 minutes. One can customize the time frame as per their requirement. For example, a high frequency trader may want to use a 1 minute chart instead of any other time frame. As you can see from the table, the number of candles increases when the time frame reduces. Based on the types of trader you are, you need to take a stand on the time frame you need. The data can either be information or noise. As a trader, you need to filter information from noise. For instance, a long-term investor is better off looking at weekly or monthly charts as this would provide information, while on the other hand, an intraday trader executing 1 or 2 trades per day is better off looking at the end of the day or at best 15 minutes chart. Likewise, for a high frequency trader, 1 minute charts can convey a lot of information. So based on your stance as a trader, you need to choose a time frame. This is extremely crucial for your trading success because a successful trader looks for information and discards the noise. Key takeaways from this module. 1. Conventional chart type cannot be used for technical analysis as we need to plot 4 data points simultaneously. 2. Candlestick charts are used by traders to determine possible price movements based on past patterns. 3. Candlesticks are useful when trading as they show 4 price points open, close, high and low throughout the period of time the trader specifies. There are two types of candlesticks, bullish candle and bearish candle. The structure of candlestick however remains the same. 5. When close is greater than open is equal to it is bullish candle. When close is lesser than open, it is a bearish candle. 6. Time frames play a very crucial role in defining traders' success. One has to choose this carefully. 7. The number of candle increases as and when the frequency increases. 8. Traders should be in a position to discard noise from relevant information. 9. Many algorithms are based on the same price information shown in candlestick charts. 10. Trading is often dictated by emotion, which can be read in candlestick charts. And this brings me to the last part of the episode, and that's the study materials to help you understand the candlesticks and Indian stock market better. You will be able to get the study materials from the link in the description. Read through them and let me know what you think. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button, and for more such insightful videos, please subscribe to our channel. Thank you so much for watching. I'll see you in the next one.